everyone. First of all, advance wishes for Diwali 2024. Since a lot of you have requested for 2024 Diwali stocks, I thought that before we discuss them, let us quickly review the performance of the last two Diwali portfolios. That would give you a fair idea for past performance and if it is worth considering the Diwali 2024 picks or not. So during Diwali 2022, I discussed 10 stocks, not just for next 1 year, but investment in SIP mode for next 10 Diwali. And then next year, I discussed 15 stock for Diwali 2023. So let us quickly review the performance of both the portfolio and identify the hits and the misses. This is the first portfolio we discussed during Diwali 2022, where we covered 10 SIP grade stock for next 10 years. Let's quickly look at these 10 names and figure out their performance. So first name was Titan. The logic for including Titan was simple. India is one of the biggest consumption market in the world with 145 crore people. And Titan is very well positioned to benefit from this trend. It has got leadership in jewelry segment with brand Tanishq. That is also into your eyewear. It is also into your watch segment, expanding into your perfume segment, sari wear. So there are a lot of categories and of course brand name of Tata Group, and Titan is a household name in India. When we discussed, it was at levels around 2,665 during 22nd October 22. So this is the performance for 1 year, Diwali 22 till Diwali 23. In 1 year, it generated 22.5% return. That time it was at 3,266. Fast forward today, it is at 3,280 and returns are 23%. It means in last 1 year, Titan has not generated any return. And the reason is only one, where valuation of Titan is on higher side at currently trading at a PE of 84. So in spite of no return in 1 year, its PE is still at 84. Then second stock we discussed was Polycab. Again, the leader in wires and cable segment, and there's a massive demand for wires and cables across industries due to your increase in power and transmission activities, then data center, and of course you need cables and wires for construction activity everywhere. Right, and that's where Polycab, when we discussed, it was at levels of 2,698. 1 year it generated 93% return. And fast forward today, it has generated 136% return, currently trading at 6,371. Third stock was Dixon Technology. Again, electronic sector, India is booming big time, and Dixon is a leader with manufacturing of mobile, TV, washing machine, and a lot of stuff. When we discussed, Dixon was trading at levels of 4,275. In 1 year, it generated a modest 29% return, but fast forward today, your Dixon is at levels of 14,177, generating 231% massive return in just 2 years, right? Currently trading at a PE of 115. Then we have got Jubilant Food, and Jubilant Food, when we discussed, it was at levels of around 590. This was one stock that generated negative return during the first year. It touched levels of 527. Fast forward today, it is at 587, the levels that we discussed 2 years ago. So 2 years, no return. While discussing Jubilant Food, logic was simple. QSR industry in India, I believe that it has got a long way to go. Again, part of consumption theme, and there's a growing interest among youth to eat fast food, and Jubilant being the parent company of Domino's Pizza, I thought that it's bound to do well. The only challenge is that in last 2 years, first of all, there has been an increase in inflation in India that resulted in increasing expenses for all these QSR chain. Second challenge is there's a slowdown in consumption for these fast food. Again, it could be one of the reasons is there's a growing competition from your quick service restaurant like Zomato and these food delivery segment. Another reason is because of inflation, probably people have reduced eating out. But yeah, net, there was a reduction in revenue growth, and because of increase in expenses, their operating profit fell down badly, and that was the major reason Jubilant has been an underperformer in last 2 years. Then next we discussed Tata Power. Again, logic was simple. Your power as a theme is massive, right? Because renewable is one of the biggest theme for 21st century, and Tata Power is very well positioned to benefit from this trend. When we discussed, it was at levels of 218. First year return was just 13.3, but in 2 years, it has almost doubled. Currently, it is at 425, generating 95% return. Next, we covered ICICI Bank and IDFC First. So 2 banks we covered. Again, banking sector, I always say it's the backbone of the economy. Your economy cannot grow without banks, right? Because everything is linked to the financial sector. So within large cap, my pick was ICICI Bank. When we discussed, it was at 907. First year it was quite flat, generated just 2.7% return, but look at that. So far till date it is now at currently 1294 and generated 42% return. Next, IDFC First has been, so first year it was quite a great outperformer. When we discussed, it was at levels of 57, jumped to 89, generated 56% return. But fast forward today, your share price has fallen to levels of 67. Net the returns are only 17%. So in this portfolio, return so far, IDFC First has been the biggest laggard, where the returns have actually fallen from 56% to 17.5%. Again, I believe that this is a difficult phase this entire banking sector is going on, and especially IDFC First is facing challenges of high provision. So I still have faith in the leadership of Mr. Vaidyanathan, but I am closely watching it. Okay, this is very important. You cannot blindly trust. Of course, you have a thesis of growth. On basis of that, you invest in a company, but you cannot marry a stock. If the stock underperform, if the company underperform, you have to take a call to exit. And that's where I always closely track these quarterly performance. So this is the Excel sheet that I maintain quarter on quarter, where I track the performance of every company. There are more than 200 companies that I track their performance quarter on quarter. Then I also discuss I'll give a review on how is the result. Then you've got all these data points like market cap, valuation. So I also give a commentary on the valuation side, then a detailed commentary like what is the expectation, what are the hits and misses. So based on that, it gives a lot of ideas. So this is only for the close community of long-term investor. In case you want to access this along with which stocks I am buying, you can explore my weekly video series that include one exclusive video every week. You can find it on my website, sahilbhadviya.in, or if you can visit the join button of this YouTube channel, there also you can find the details. Right, so moving on, we have got two more stocks that we discussed. One is CAMS and CDSL. Again, these two stocks I've discussed multiple times on my YouTube channel also. CAMS, when we discussed, it was at levels of 2,635, and then it was again second stock that underperformed during the first year. Return were -5%. And I remember clearly people saying that this is one of the bad pick. But look at the kind of return. So far, it has generated 62% return. So from levels of 2,500, today it is at 4,289. Right, so 1 year is a very short period for you to really gauge whether the stock would outperform or underperform, because we are looking at a long-term bigger picture. It's not just a short-term 1 year game or 2 year game, right? So that's where you have to figure out there can be hits and misses in the near term, right? So for example, IDFC First, it outperformed first year, second year it underperformed. CAMS, it underperformed first year, second year it outperformed big time. Likewise, CDSL, look at it. When we discussed, it was at levels of 600. First year return was just 11.9%. Fast forward today, the returns are 147% in just 2 years. Right? Of course, it's because of the upcycle in the industry. Again, I'm not taking all the credit. It's thanks to the entire bull rally we have seen. Otherwise, you can't expect these kind of crazy return in stock market over the long term. See, discussion on CAMS was very simple again. It's a long-term story of mutual fund investment in India. There are only two RTAs, leading RTAs, CAMS and KFIN, where CAMS has got nearly 65 to 70% market share. Then CDSL, again, it's a proxy of mutual fund investment. There are only two depositories, your CDSL and NSDL, and that's where we discussed both CAMS and CDSL. They are part of my long-term portfolio. And then last name we discussed was MapMyIndia. It was at levels of 1,300. In first year, it generated 49% return. But so far till date, it has generated 45% return. So slight fall. Again, net 1 year, actually, the returns have reduced from 49 to 45%. Only reason I could see is valuations were too high after 49% return. And even today, it's trading at levels of 46 PE. So all in all, this was the portfolio. First year, this portfolio generated 26.29% return against Nifty 50 return of 9.7%. Okay, so Nifty during October 22 was levels of 17,576. Next year, it was at levels of 19,281. So 9.7%, and Nifty 500. Again, here we are comparing with two benchmark, Nifty 50 and Nifty 500. Ideally, it should be compared with Nifty 500 because it includes all large, mid and small cap. So Nifty 500 returns were 10.8%. Against that, we generated 26.29%. Clearly, it's a excellent outperformance on the first year. And second year, look at this. So far, this Diwali 22 portfolio has generated 80% return against Nifty 50 return of 38.6% and Nifty 500 return of 48.7%. Again, it's a good outperformance from this Diwali 2022 portfolio. Having said this, let me clarify, this is an exception. 80% return in 2 years, you can't expect year on year. Otherwise, if you expect your portfolio to double every 2 years, in 20 years, your 10 lakh would become 100 crore. Your 1 crore would become 1000 crore. That's 1000 times return. It's crazy. You can't expect that. Right? So you need to have right expectation. It is mainly because of the ongoing bull rally. My goal is to beat Nifty 50 and Nifty 500 by a decent 2-3% margin. That is the expectation. That's it. Because here I'm also ensuring that the returns are not only based on the risk, but it is risk adjusted return. So that is again very, very important part. So this is Diwali 22 review. Let's move on to Diwali 2023 picks. So last year I discussed 15 stocks, okay. Let's start with, so I've sorted this list by returns from top to down. First was Hindustan Aeronautics. When we discussed, it was at levels of 1900, market cap was 1,27,000. This was on 5th November. Fast forward today, its market cap is 2,77,000, currently trading at 4,100 crore. By the way, it touched levels of 5,700 crore, but from there it has corrected significantly. So even then, the returns are 118% from Hindustan Aeronautics, right? Trading at a PE of 33. Next top performer from last pick was Sansera Engineering. When we discussed, it was at levels of around 836 and currently it is at levels of around 1500. So it has generated 78% return from last 1 year. Third stock was Tata Power. Again, we repeated Tata Power in last year Diwali pick and it has generated 74% return. Okay, then we had ICICI Bank, which is again a repeat from Diwali 2022 picks and has generated 38% return. Next was Tata Motors, and when we discussed, it was at levels of 648. I remember it touching levels of 1150. From there it has fallen nearly 28-30% to levels of 879 and currently trading at a PE of 7.5. And returns have now reduced to 35%. Earlier the returns were quite high, but today the returns are 35%, especially after this recent correction. In fact, this Diwali 2022 pick, I remember at one point in time it touched nearly 100% return, but recently because of pullback, it is at 80%. And then Diwali 2023, we have got another name was Bharat Forge into your defense and your other auto auxiliary space, where when we discussed, it was levels of around 1031. Today it is at 1361, generated 32% return. Next in the list was Praj Industry. Again, it's into your biofuels and beneficiary of your waste management and a lot of things. And when we discussed, it was at levels of around 547. Fast forward today, it is at levels of 704. So it has generated 28.6% return. Next, we had Federal Bank. When we discussed, it was at levels of 144. Today it is at 185. So it has generated 28.7% return. Next, Sona BLW from auto auxiliary space, one of the leading player from your auto auxiliary electric vehicle segment. When we discussed, it was at levels of 548. Today it is at 691, generated 26% return. Then we had Precall that has generated 24.4% return. Next, couple of affordable housing finance name, Home First, that has generated 20% return. Aavas generated only 13% return. Next is Lemon Tree, that has been an underperformer with just 5% return, and two stock from this list that has generated negative return. One is IQ Lighting. Again, I've discussed recently some of the underperformers from the past discussion and mentioned the reason for underperformance of IQ also. So IQ is down by 17.8%, and last Equitas Small Finance has been one of the biggest underperformer, currently down 28.7% from this list. So if you look at it, net our portfolio from Diwali 2023 has generated 31.8% return against Nifty 50 return of 26%. So as compared to Nifty 50, it's a decent outperformance, but as compared to Nifty 500, it is at par. I mean, just slightly 1.5% below Nifty 500. So clearly this has not outperformed Nifty 500 in last 1 year. Again, what I believe is, especially if you look at the valuation. So first of all, one of the reasons why this portfolio has not outperformed is because out of 15 stocks, 5 stocks we considered from banking and financial space, and this entire banking and financial space has struggled big time in last 1 year. So we discussed ICICI Bank, then Federal Bank, Home First, Aavas, so these are NBFC, and last Equitas Small Finance, right? So 2 private banks, large cap and mid-tier bank, then 2 NBFC and 1 is Equitas, which is small finance bank. And that is one of the reasons our portfolio has been dragged, because last 1 year major outperformance has come from your power and transmission, infra segment, and these kind of stocks. In fact, renewable sector as well. Right, so again, not defending this portfolio, but all I'm trying to say is these are the 5 stocks that we had from banking and finance. And the good thing is, look at the valuation. After the correction, Equitas P is at just 12.59. Then your Home First P is 29, Aavas P is 25, Federal Bank P is just 11. Then your Tata Motor P for that matter is just 7.5. So I believe that even ICICI Bank is just 20.37. So in my opinion, I think some of these stocks that have underperformed in last 1 year, I am hopeful that by next Diwali or next to next Diwali, some of these underperformers will eventually outperform, because we have seen it in the past. Stocks like CAM, CDSL, they underperformed and then they outperform big time next year. For that matter, even your Dixon, it was just 29% up and then generated 231% return. Even ICICI Bank was just 2.7% return, generated 42% return. So all I'm trying to say is, don't just look at 1 year of performance, try to understand how's the pedigree of these stocks. What was the thought process behind it? Because I felt that last year also banking and finance were underperformers, and there was a good valuation comfort, and even today I believe there's a valuation comfort. The only issue is it's getting a bit tricky in terms of the NPAs and the provision, so we have to track it very closely. Otherwise, I believe that eventually this situation would resolve and banking and finance would do well. So this was the portfolio from Diwali 2023 and this was Diwali 2022. I hope you got a fair idea of the performance. That's it from my side. Stay tuned. Tomorrow we'll be discussing Diwali 2024 picks.